Welcome to the Passive Income Podcast. I'm your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for today's guest, Josh. Please follow him on Twitter. Twitter handle at Habits, Money Making Habits, I believe, is the Twitter handle. I'm
Yep.
going to throw it over to you, Josh, and you can just go ahead and give yourself a little bit of an introduction.
Okay, great. Well, first off, thanks, Dave. Thanks so much for having me on. I've watched a bunch of your videos so far to prepare for this, so I'm excited to join the posse. So thanks a lot. Um,
Nice.
my background, I'll start all the way from the beginning. I came from grew up in a single parent household, so money was always a big theme for us in our house. We moved a lot. We had some challenges growing up. And because of that, I've always been really in tune with money and really strive to.
Or the lack thereof, right? Single parents are always struggling for sure.
Exactly. Yeah. So just trying to see how I could make that dollar stretch. And over the years, I got into investing. I probably got into investing probably about 10 years ago. Started with mutual funds, moved to DIY, did a lot of high risk stuff, learned good lessons there. Moved
We've all been there.
moved out of that, actually started getting into real estate just to diversify more. And then over the past 2 years, I've been in dividends. I love dividends so much so that I even created a blog about it. So looking forward to talk to you about that.
Yeah, for sure. Yeah, we'll definitely talk about your blog here. And yeah, I agree with the falling in love with dividends. There's, one of my most favorite things in life, like top three favorite things in life, is when companies pay me to not work for them.
Yeah, yeah, for sure.
Every month, every quarter, they just give me more money, and then I take that money and buy more shares, and then the next month or next quarter, they pay me more money to still not work for them.
Yeah, I actually when I started investing, I did touch dividends, but I really didn't appreciate the power of the dividend. I had no idea about raises, and that's an integral part about the dividends. And then just seeing like a health check of the company that's able to sustain and grow their dividends really speaks to that. So kind of getting into that, I'll call it a black hole of dividends, but really learning about that over the last 2 years as I continue this investing journey has been great.
Yeah, for sure. And I see your point there too. Like maybe early on in that investing journey, you just happen to invest in a company that pays a dividend, and you're like, oh, great, 50 cents. What am I going to do with that? But then you start to see over time, oh, that 50 cents can turn into a dollar. That dollar can turn into two, turn into five, turn into 10. And the snowball keeps growing.
Yeah, yeah, for sure. Yeah, and I'm starting to realize that I've been tracking my dividends probably about 15 months now, and I'm seeing that snowball effect really happening with the dripping. Um, I'm a big fan of fractional dripping, I call it. So
Okay.
there's a broker in Canada. I won't name the name because I don't get paid by them, but they you're allowed to buy fractional shares. So what I do with my dividends is I'll buy. If I don't have enough for one drip, I'll just buy a fractional share, or if I have more than one, I'm still able to drip that way. It's all manual. I have to do it myself. They don't have a dripping program, but it just allows me to drip regardless of what kind of dividend I'm getting from the company.
Yeah, exactly. Exactly. So, great point there. You mentioned you're also in Canada, as my viewers and listeners know that I'm in Canada as well. However, I was looking at Josh's blog earlier, and he does have U.S. holdings. So, any of our American viewers, please stick with us because I'm sure we will be talking about a lot of companies both in Canada and the U.S. So, we'll just see where the conversation takes us over this next little while.
Yeah, yeah. Within my portfolio, I strategically done it for tax reasons. We in Canada we call it an RSP. It's similar to a 401k. So we have a treaty with the U.S. So all my U.S. holdings are in those accounts,
Yeah.
and then I really leverage our tax-free savings account for any Canadian dividend stocks.
Right. Yeah. That makes sense. That makes sense. 100%. Yeah, so let's dive into it, and I guess just start talking about some of the different sectors, different companies within any of those sectors. Um, I guess, do you have a favorite company, a favorite sector?
Our biggest holding today is TELUS. So that's in the telecom sector. It's a Canadian telecom. We like it for its dividend growth policy. They're also doing a lot of interesting things with AI and really trying to grow that portfolio with health and agriculture. And then there's just that push to expand in Western Canada. So I'm in Eastern Canada. I'm not an expert of Western Canada, but I certainly see that growth opportunity there.
Yeah, for sure, for sure. TELUS is very high on my watch list. I don't own TELUS. I do own Bell, and I guess sticking with the Canadian telecoms, obviously you have your Bell and TELUS, the big top two, and then with Rogers, and we'll see what is ever going to happen with this eventual acquisition of Shaw Communications, and and that affects Quebecor as well. So it's quite an interesting dynamic of what's going on with the just within that acquisition itself. But I guess throughout the whole telecom sector, I've mentioned many times before that you know uh, I guess I know Bell more than Telus as well. Um, but Bell is also, Bell Media is sort of becoming one of the biggest arms of that company, right? Owning so many different television networks and such. And yeah, I haven't done a whole lot of research on Telus, but like you said, they're getting into the healthcare, like what do you call it? Like, well, almost like this, right? That you go to your doctor over a video call, right?
Yeah, telehealth.
Telehealth, right?
Yeah, yeah. Yeah, we own Bell as well, and honestly, probably would have owned Rogers, but they're not a dividend increaser. And then, like you mentioned, they're having some challenges with the merger they're trying to do. They have a lot of like nasty family stuff that happened last year. They had that
Oh
big
yeah,
black,
wasn't that crazy?
yeah, and then they had the big blackout, which was interesting because like Rogers shut down for a day, and it impacted so many businesses, retail sector, et cetera. So it just really speaks to how much we depend on our telecoms, how
Right.
highly regulated there are. They're very moat. It's hard to enter. A lot of the companies in our portfolio are kind of that same nature where they just have really great moat power. So not a lot of competitors. So very stable in that sense in terms of growth and dividend growth.
Yeah, a couple things to unpack there, like the Rogers blackout. When that day happened, I saw it was literally like it was a tweet, and it for me it won Twitter that day. The guy whoever tweeted it was like, and it was obviously somebody quite a lot younger. And the tweet was to the effect of, and I'm paraphrasing here, but Top Gun is the number one movie. Metallica has the number one song. There's no interact. And there's no internet. This is the closest I'm ever going to be to 1985.
Exactly. Yeah, yeah, it was a big day. Yeah,
But continuing on with that, like you mentioned the family as well, and I kind of lost track of it, but it was like the brother suing the mother and sister, or vice
yeah,
versa, the sister suing, and it just seemed like such a mess.
right. Yeah, yeah. I do remember the stock tanking significantly during that. It's come back a bit, but again, yeah, they haven't raised their dividend in a long time. Other than that, honestly, I think they still have such a huge stronghold in Canada, so they
Oh
would
yeah,
be
for sure.
affected by. But yeah, we're happy with TELUS and Bell right now for our telecoms.
Well, and then another thing to point out with Rogers, and I've talked about this with other like actually American guests, where it's like you could build an entire portfolio just around stadium names throughout North America, right? And,
Yep.
and Rogers has what, four or maybe five in Canada, like
Right.
Rogers Center, Rogers Arena, Rogers Place. That's just three off the top of my head. So, and
Hmm.
there might be more. I don't know, right? So,
Yeah, I do like that our Canadian banks are. They have a couple, in the U.S. right now, so that's awesome. We get some good exposure there
right, right.
for
Yeah, great
earnings.
segue. And before we get into the Canadian banks, I am going to give a shout out to Buy Investing Shirts. Patrick has done a great job with the passive income Posse merch dividends. You're Canadian, so you know what you actually call this, right?
Too, yeah.
A toque. Yeah. And of course, you guys have seen me wear the passive income Posse T-shirt as well. So, uh, link in the description below. Use the code word Posse for 5% discount. Let's get into the Canadian banks. You mentioned the Canadian banks, obviously the big five, big six, if you want to include National Bank in there. Obviously, all very strong. Obviously, turmoil recently in the U.S. with the regional banks, Silicon Valley Bank, and I'm not even sure there might be other regional banks kind of tied up in some of that mess. Yeah, I guess just general thoughts on banks in general and the Canadian banks, and which ones do you like most, or I'll throw it back to you.
Yeah, so for banks, so within our portfolio right now, we have 38 different holdings. We actually own all six of the banks in Canada. The reason for that is because they've just been such solid dividend payers over the years. You mentioned in some of your videos, I mean, they've been paying for almost 200 years.
Yeah.
That is incredible. We're
Yeah.
talking world wars, we're talking recessions after recessions, famines, whatever, natural
Depressions,
disasters.
the Great Depression, like
Yeah, like so
everything.
it's
Everything
unbelievable.
happens in 200 years, right? Like,
Yeah, yeah.
not just one pandemic, but a couple of pandemics, right?
Right. Yeah, it's incredible. So, um, we like, we have, I think we lean more towards, we really like how National is done the last couple of years.
Definitely, yeah.
And I just say, I go from I to we. The reason I do that is because we use registered accounts. So I have it under my name and my wife's name. So I kind of consider it as like we're a team.
Yeah.
So that's why I say we or I, but just to clarify that. So yeah, we like National. Royal Bank is also one of our highest holdings as well. They're the biggest market cap right now in the TX. They have TSX. They have been for a long time. They're pretty solid. I think they're the 10th largest bank in the world. So really good international exposure. We do like TD, even though they're getting hammered right now with the U.S. exposure, but they
Right.
seem to be trading at a discount. So we picked up a couple of shares this month. Um, but in general, we just like the banks for the solid dividend stability. The growth is there. You mentioned on your channel, we all pay mortgages, so these guys are making fistfuls of cash, fistfuls of profit, and that's not going to change anytime soon. And they're really well regulated in Canada, so you have that kind of peace of mind that they're not going to fall apart. Um, and I'm expecting more raises. We're going to get more raises in May, so probably get more
Yeah.
raises in November. So it's great.
I love when I get a raise and I don't have to go to my boss and say, "Listen, hey, I worked really hard this past year. I really helped the company achieve its goals. I really believe I deserve a raise." Dividend and dividend growth investing, they just give you a raise. You're like,
Right,
you don't even
right.
ask for it. They just say, "Here's your raise." And you're like, "Well, thank you for paying me more to still not work for you."
Yeah, exactly. It's funny you say that because like I think prior when I got before I got into dividend investing, like raises are such an integral part of working, right? And like you really look forward to them. You really have to sell yourself and say, "Hey, look how much I've done every year to your boss," and then you'll get that 3 or 4% merit increase, and you're like, "Oh, okay." And now we kind of just get it naturally. So I
Yeah.
think since last year, like I'm not even as pushy anymore with my work. I'm just like, it's okay. I'm going to get my dividend raises,
Yeah.
and the raises, um, they really help because it just helps with the inflation as well. Especially, you mentioned you're turning the cash register around. I have the same philosophy. A lot of
I
the
love it.
companies I own, we're we're consumers as well. So I have a post in my blog, 10 reasons why we love dividend investing, and one of them I talk about is just being the owner, betting against the inflation hedge.
Let's
So
bring up your blog here, and I'm not sure if I can find the one you're talking about quickly, but I'll just scroll through and you can go ahead and talk.
sure, yeah. There's only a couple articles, so it shouldn't be that hard, but it'll be that one, 10 reasons why we're dividend growth investors.
Right. Okay.
Um,
Cool.
and I actually talk about Bell, and we're a consumer of Bell, and I know they're going to give us a price increase every year with our cell phone bills, but at the same time, I know that we're going to get a dividend raise as well. So we're kind of meeting halfway there.
Yeah. So, and here's your entire portfolio. Consists of the 38 holdings that you mentioned previously. Uh, Bell, Telus. I'm going to try to pronounce that one. Alimentation Couche-Tard. I think I got that pretty close to correct.
Yeah.
Magna, McDonald's, Loblaws, Metro, Pepsi, Costco, CN Resources, Enbridge, Suncor, Tourmaline, TC, BMO, BNS, CIBC, Intact, Manulife, Wow, National Power Corp, Royal Bank, Sun Life, TD, AbbVie, CNR. You've probably watched enough to know that there's a CNR that goes by that window that you see behind me there.
Hmm.
Um, Exchange Income Core, Waste Management. Oh, that's a trash company. Apple, Microsoft, Dream. Oh, Granite, Smart Centers, Vici, Algonquin Power, and look over here at Algonquin Power minus 40. Before we dive into that, I'm going to come back to REITs actually.
Sure.
And just to finish it off, Capital Power, Emera, and Fortis. Wow,
Yep.
that is one heck of a portfolio. And then also before I throw it back, if you want to just have a good read, I was reading through a little bit of this of just sort of about yourself and your wife, and so that's a good read too. Obviously, the link will be in the description below. So sorry, like I said, I'm gonna just click that off the sharing tab. REITs. I see
Hmm.
you have some REITs in there. Viewers, my viewers and listeners know how much I love my REITs. I love the monthly dividend, and I've said this every time. I'm like, listen, I know 5 or 6% is 5 or 6%, whether it's paid monthly or quarterly, but just almost something psychological about seeing that roll in every 30 days on say the 15th or 16th of every month, and just that little bit more helps. Um, so yeah, I guess just talk to some of those REITs that are there in your portfolio. That Vici one too, if I'm not mistaken, is that the one that owns like the properties on the Las Vegas Strip?
Yeah, exactly. That was a new addition. We just picked that up. It's yeah, they own a lot of the casinos. It's interesting because those leases are like 40 years long. These casinos aren't going anywhere, so
Right.
it just seemed like an interesting play. They've had pretty good growth. It's a relatively new REIT, but they've had good growth, good dividend raises. So we took a flyer on BICI. Um, I don't have RioCan. I know you love RioCan, but I do have a story about RioCan.
Oh,
Uh,
please do tell.
yeah. Well, I it's when I started investing, it was probably one of the first stocks I owned for a long time, and really, it's just something I recognized because I lived in like North York at the time, so we would see RioCans everywhere in all the retail spots,
Right.
and I was really just gravitated towards like when I buy things, I really like to buy things that I understand.
Yeah.
If I don't understand the product or what they do, I won't touch it. That's the reason I never got into cryptocurrency. So I think that worked out well. But with RioCan, we owned it for a long time. Um, I did end up selling it because of the cut recently, and we also had Smart Center, and we like Smart Center more because they've had more raises for the most part, and their
And they're
biggest
very
customers.
similar, right? Smart Center
They're
and
very
Marocan
similar. Yeah.
are very similar types of
Yeah.
REITs.
Yeah, and then we just like how they're the biggest landlord of Walmart in Canada. So
Yeah.
that's the reason we don't have RioCan, but potentially we would add it later on. The other ones are on the industrial side, so that's more e-commerce. I certainly see that's the future. Whenever I travel to the U.S., I mean they're just popping up. Even where I live, they're just popping up everywhere. These industrial giant warehouses that are going to support the future of e-commerce. So
The Amazon warehouses, right? Somebody owns that property in that building, and you might as well get in on that action.
yep. But I certainly share the love with you for REITs in the sense of monthly payers. The reason they're not a significant part of our portfolio is because we do have rental properties as well. But if that were not the case, and it probably won't be in the future, I don't think we're going to be, physical landlords forever. REITs, I would suggest, would should be at least 10 or 20% of your dividend portfolio.
Yeah, yeah. You know, that's kind of funny that you say that because obviously, investing in REITs gives you that exposure to real estate without being the landlord. But if you already have that physical real estate and you are a landlord for whatever it is, one, two, five, 10 properties, then
Yeah,
do you really need that exposure to the REITs, to the real estate through REITs? And
Right.
again, that just comes down to personal preference, personal decisions, and obviously you've made the decision to, hey, we've got some physical real estate, but we're also going to invest in some REITs. Like, why not?
Right. Yeah. Because I'm never going to own an industrial warehouse. So that seems like, even though it's a REIT, to me, it's completely different. Owning,
Yeah.
you know, casino properties, or I'm never going to be a
Yeah.
physical owner of those. So that seems like an interesting opportunity as well.
It's like, how much is it if I just wanted to buy the Bellagio?
Maybe one day we'll see how these dividends work out. Yeah. So certainly, I certainly share your love for REITs, and that was like when I was learning about dividends. I mean, that was probably the first one I got stuck to, was the REITs, because it makes sense, right? It's very logical that everybody has to pay their landlords, and it's a
Right.
big part of the overhead, and it's consistent. If you have these consistent tenants that are landmarks there, they're not going to leave. So there's a lot of security there.
Yeah. And so going back to Ryokan, and very similar to what you said, like owning what you know. And I know Ryokan primarily because of the property that they developed in Kingston, Ontario. Kingston is my hometown. I was born there. I was raised just north of the city. So, back in the 90s, it was actually a Nortel property. And I mean, you and I both know what happened to Nortel.
Hmm.
And then sometime in I guess around the early 2000s, Ryokan came in, bought the property, developed it. And now there's like, 3, 4 football field uh, size of just retail space, Home Depot. There's a couple of Canadian bank branches. There's restaurants. There's movie theaters. There's obviously tons of other retail shops throughout the complex, and so that's I guess a big part of my appreciation for Ryokan is just seeing what they did 20 some years ago on that property, and just physically seeing it and knowing it. And
Right.
going back to what you said about the dividend cut, they actually just last month, I believe it was just last month, started to increase the dividend again. So hopefully, well, obviously they're on the rebound if they feel they can increase the dividend again.
Yeah. Yeah. No, it's good news, and I hope they do. Um, and yeah, maybe we'll be buyers again.
You never know, someday, right? Now, I do have to bring up a touchy subject, and this is for both of us because I did see there when I was sharing your portfolio on your website, the Algonquin Power down 40%.
Hmm.
And I own some Algonquin as AQN, ticker symbol AQN. And obviously that dividend cut back in January, it hurt. But at the same time, we knew it was coming. The writing was on the wall for the all of December and back into last November. I'm sure for the most part, people saw that there was a dividend cut coming. And I've talked about this with others on this podcast and actually with Anthony on his channel as well, saying, it was kind of a good thing when they cut that dividend because they ripped the band-aid off, so to speak, right? So I don't know. I guess just thoughts on AQN first, and then more so into that sector.
So AQN is interesting because everybody loved AQN in like the dividend growth community. They had stellar increases. The business model looked great, but they just did too much too fast. And now we're in a situation where they have a lot of debt. They're still trying to complete an acquisition, which probably
Kentucky
is going
Power.
Kentucky Power, which is probably going to mean more dilution of the shares to raise more money. So it is concerning. So I did write about it in one of our monthly updates. We did cut about half our position on that AQN. We're keeping the half. It looks like actually the stock is starting to go up a bit. And honestly, it should. I mean, we're talking about regulated utilities. They shouldn't be volatile stocks. So that's why it hurts so much, because it's a utility, right?
Right.
But we decided we didn't want to really play any more games, so we sold half, and we actually moved it more towards Fortis, which is like one of the best dividend stocks on the TSX. It's going to hit that 50-year raise aristocrat status this year. And then Amera, which is on the East Coast. So we got West Coast and East Coast. Utilities are another core part of our portfolio. These are just very boring regulated stocks that I'll keep.
Boring is great though. Like people need
Yeah,
utilities. You need
yeah.
you need things to turn on, right? You need the
Yep.
water to run. You need the lights to work, and like utilities are essential. And like you said, they're boring because we don't think about it. You get up in the morning and you flick the light on, or at night you flick the light off, or whatever, right? And you don't think about it, but they are very necessary.
Right. Exactly. So I certainly recommend that for a portfolio. You can see in mine or ours, it's very diversified. I really try to touch every sector, and I'm really trying to balance it out, and that's intentional. As an example, last year everything was down and oil was up, so our portfolio didn't look as bad as it could have, and now it's kind of changing a little bit. But the financial sector goes down, but something else will go up. So we're always trying to just kind of find that balance within the portfolio. So utilities are a big part. But for Algonquin, I would say yeah, I'm a bit cautious right now. I know some people jumped in kind of under the $10 mark, and perhaps that'll pay its quote unquote dividends. But let's see what happens with the management. It's still questionable, right? What
Yeah,
they're
for
going to do
sure.
next.
Yeah, actually, when that dividend cut happened back in January, I tweeted out something to the effect of, "Is now the time to be greedy while others are fearful?" And I, honestly, I kind of wish I had have picked up more AQN at that time when it was like it might have even dropped below $9 Canadian for a couple days. And honestly, I regret not grabbing a few more shares at the time, because at the end of the day, they do still have a lot of very valuable assets,
Hmm.
and I don't believe they're going away anytime soon. Like, AQN is still going to be a very solid company 5, 7, 10 years down the road. And hopefully in 10 years down the road, we just look at back at this 40% dividend cut as just sort of a blip on the chart, or a blip on the history, or on the map, or however you want to phrase that, right?
Yeah, I mean, if you like the company, I think it's trading at under maybe around $11. If you like the company, I mean, $9, $11. 10 years from now, if it's going to be a successful company, what does it matter, right?
Right. Yeah, exactly. Exactly.
It's all kind of that psychology you get. I think you get stuck in as an investor. People really hold on to money like I'm going to buy it on this day. For me, I did that early on, and that really, I would just get tripped up so much. So now it's just like I'm very intentional with my purchases. If I like the company, I'm going to buy it, and I'm going to sit and wait.
Yeah, for sure. Now, another kind of big sector I noticed in your portfolio, and I love it too, because, well, I just lump it into food, but obviously it's consumer staples and consumer discretionary. Consumer staples obviously being the things you have to buy. You have to buy enough food to survive for a week or two. So you're going
Sure.
to your uh, grocery store. And then obviously the consumer discretionary being, well, the Coca-Cola and the Pepsi, they're in the
Hmm.
grocery store, but you don't have to buy those.
Right.
Um, and I did notice when I had your portfolio pulled up there, it looked like you had quite a bit in that uh, food sector.
Yeah. It's a same idea again. Like be the owner, buy what you're buying. In Canada, there's this like general theme, right? Everything is almost like a duopoly. There's only so many grocery stores we can buy from.
Right,
Um,
Loblaws, Metro. Do you have Empire
Metro.
in there as well, or no?
I don't. I didn't give the East Coast a lot of love, but I do have Costco.
Right, Costco.
Yeah,
Yeah.
yeah. So yeah, same idea of just and these guys have done stellar in terms of not only during the pandemic, but just if you look at their 10 year, their 20 year, the growth is insane, and it's going to continue. Costco is really interesting because they have that membership as well.
Hmm.
So I believe I read that the membership alone subsidizes their whole overflow, and then everything else is just gravy. All the store sales. Um, so yeah, we have those. Another one is McDonald's. I'll highlight that. I think
Yeah.
McDonald's is just such a global superpower. They have such strong brand power. They can raise their price. People are going to continue to buy. Um, and I travel a lot. I see McDonald's everywhere. They're always busy. So that's one we like. The one we got
Oh,
bought it right around the whole Russia Ukraine situation. So we haven't recovered from that, but we're still holding that.
yeah, interesting. Yeah, McDonald's, like you said, they're in. I think is there a country in the world that they're not in? Maybe North Korea, but other than that, they're everywhere, right? And I guess that recently they're just not in Russia anymore as of just last year. That's a whole other story, obviously, but
Right.
um, yeah, uh, a great sector to be in, and definitely this is part of my opinion too. Is like everybody eats every day, so
Yeah.
whether you're investing in Costco, Walmart, or here in Canada, you got your Loblaws and Metro, and like I mentioned, the Empire that owns Sobeys as well. People have to eat. Everybody eats all day, every day, right? And I feel that those are somewhat recession proof as well because
Yep.
your stomach doesn't know if there's if the markets are up or down or if it's a bull market or a bear market. Your stomach is still saying, "Feed me every day," right?
Yep. Exactly. And I consider those growth stocks too. I mean, they have pretty low yields, especially the grocery stores. They're around like 1.5%. So they're not as sexy. It's kind of the same as like Canadian Rail, right? Really low yield, but the increases are there, and just the stability of the company and the growth is there as well. So certainly recommend to have that kind of discretionary defensive plays within a dividend portfolio as well.
Yeah, for sure, for sure. Yeah, so we've touched on REITs, banks, telecoms, food, a couple. Well, we touched kind of on utilities as well. They're mostly AQN. That's fine. Um, other or sectors, I guess. Healthcare. Healthcare is a tough play in Canada. Well, actually, I did notice AbbVie there in your portfolio, so that's kind of your healthcare play, but more with the U.S. stock.
Yeah, it's actually our only healthcare play right now. They're a big pharmaceutical spinoff of Abbott, and that one's been pretty good for us. So we do have a big position in that one, um, and that's within our RSP. So we're not paying any taxes on the dividends right now.
Nice. Yeah, and AbbVie is a Twitter favorite too. I know you're new to Twitter.
I am, yeah, yeah. You have to teach me. I think you're my sixth follower, so thank you so much.
I'm gonna bring up I'll bring up your yeah, you have 6 followers. You've made 18 tweets in 2 months, and honestly, I could make 18 tweets in one day. You got to up your Twitter game, man.
Yeah, is that part of it? It's just yeah, okay, yeah.
That's
I
part of it.
mean,
Yeah, the
yeah,
more you tweet,
yeah.
the more involved you get with the Div Twit community. Like the Dividend Twitter community is amazing, and I know after this episode, more people will follow you for sure. Obviously, too, because you're a great guest and providing very valuable insight. So,
Thank you.
yeah,
I will say I did use Twitter like 10 years ago at a company because I had to do their socials. Um, and I did that for a couple months. And after that, I never used it again. But I certainly agree with you, especially for like the div twit. So I've been posting a lot of my articles on Facebook. There's a really good Canadian dividend growth group, and that's usually where I've been posting my articles. But yeah, I recently joined, I think in January, on Twitter. So
right.
certainly I see the power, and it looks like everybody hangs out there from the community. So it's pretty cool, and certainly something I do want to leverage more, and appreciate the kind words and advice.
Yeah, well, the beautiful thing I love about the Div Twit community is just the support and the positivity. People will post, "Oh, I made a 50-cent dividend. Oh, I made $1.76 dividend," or somebody will
Hmm.
say, "I made $150 dividend," or even some of the bigger accounts will say, "I made 5 grand in dividends in this month." And the reaction is the same, whether it's 50 cents or 5 grand. The reaction is the same, saying, "Good job, great work, keep it going, keep the snowball, like you know, keep adding snowflakes to the snowball, keep building brick by brick," right? And everybody's just so super supportive of everyone else. So that's primarily what I like about the div. Well, it is what I not primarily it is what I like about the div twit community. The absolute most is just everyone is so super supportive of each other.
Yep. And I would say, Dave, you have a big part of that. I mean, your videos are, I mean, you're really celebrating everybody in the community. So thanks a lot for everything you do. It's pretty incredible. and you're really making, an anthology of all these great conversations. And
Right.
yeah, I think it's awesome what you're doing.
Yeah, I appreciate that too. Those are great words. I love hearing that from people, obviously, and yeah, that's exactly what I'm trying to do here is just give everyone a voice. Everyone that wants to have a voice, I'm giving it to them, basically, right? So, um, let's jump onto a couple other sectors. You did mention the railways there briefly, so
Hmm.
let's jump into transportation. Obviously, the big two in Canada being CN and CP, and I know there's a few other transportation companies that are publicly traded. So I guess just dive into that sector. What are your thoughts?
Whenever people ask me about advice for investing, I always say own a railway. Railway is just such an important part that should be in your portfolio. It's still considered relatively cheap transportation to transfer goods, um, and it's so hard to enter into that sector. I mean, it's
Right.
so capital intensive. There's not going to be, another new railway that pops up. So I certainly recommend. Um, I think you can pick either or. I think both the two big ones in Canada, I think, are pretty strong. We went with CNR, but if you pick the other, I think that's fine. CP. Um, in terms of other industrials, transportation, I personally work in aviation, so I don't own um, I don't own any of the airlines or things like that. But I do own Exchange Income Fund. So they're a really interesting play. They're a monthly dividend payer, so that's cool as well. Pretty good record of raises, and they do a lot of business, a lot of transportation in northern Canada, which is a niche market. There's not a lot of competition there, and they just have a lot of different kind of small industrial plays within their portfolio. So we've owned them for a while. They've been really good to us. So that's one I would recommend. That would be on my top 10 exchange income fund or corporation,
So
EIF.
that's an ETF.
Nope, nope. It's a holding. Yeah, an
Okay.
individual company. Yeah, but I
And the
recommend
ticker symbol is
EIF .to.
EIF. I'm gonna have to look into that one.
Yeah.
I think I have seen it. I think I have come across it before, but sort of one of those you're scrolling, and you don't pay attention because that's the way we are these days. You just scroll and absorb like 10% of what you're scrolling through.
Mhm. I
Unfortunately, that's the
yeah.
way it is.
I probably owned it at least 5 or 6 years, and yeah, we've seen our position double, and then we get the dividends on top of that. So that one's been very good to us, and I still think they have a really strong, uh, you know, position within their sector.
Right. Yeah, and like you said, obviously Northern Canada is a very niche market. It's for the most part a lot of remote communities, and
Hmm.
you still need to get goods to those communities somehow, some way.
Yep.
Technology. I didn't see too many technology stocks in when we were looking at your portfolio. Any thoughts on anything in the tech sector?
So when we became dividend growth investors, I was very intentional, and I got rid of everything that doesn't pay a dividend. That's how hardcore I am. So I got rid of all my kind of growth stocks, everything like that. Today we have small positions in Apple and Microsoft, both obviously excellent, well-known companies. The reason we're not heavy in tech is because my work pension, I have basically an S&P 500 fund, which is heavy, heavy tech. So
Right.
that's basically my kind of like ETF that I use, and then I have this DIY portfolio. But if it wasn't for that, I'd probably pick up more tech just to spread out the growth. But yeah, I mean, Apple and Microsoft, you can't go wrong. They have such a foothold within the industry, both
Right.
dividends as well. So yeah, those are our two plays, relatively small.
Yeah, and obviously, their both of their yields are also relatively small.
Hmm.
But yeah, you can't go wrong with those two. Again, not financial advice, but you
Yeah,
know,
yeah. We should
with
have said that at the
Microsoft,
beginning.
o-
Yeah.
obviously you've got your Microsoft Office. Everybody that I know uses Excel. People use Word, people use PowerPoint. That
Hmm.
Microsoft Office suite of products is, and it's a subscription service. So every year, And I'm sure companies pay way more than just what like an individual pays to have it on their personal laptop. And then obviously with Apple too, you have just the iPhone alone, right? Like I'm not an iPhone fan. I've had them in the past, and I prefer Samsung, but I feel like I'm in the minority there. Like the majority of people seem to have iPhones. So
Yeah, I actually switched over everything Apple. I used to be on the other side. Now I'm Apple, and I mean the computer is awesome and everything. So great products. I think just one thing I want to touch on. We kind of touched on it a bit during the conversation, but
sure,
yields, high yields, low yields. So when I first started, I was always chasing the higher yields. I didn't have that discipline, and that's something I really learned the hard way. A
yeah,
lot of the really high yield stocks, generally, you got to be a bit careful with those if they can sustain them, um, because you don't want to be chasing a high yield and then have the stock plummet. You're not going to make any money that way. So, I certainly found a lot of success with a lot of the smaller yields. Small yield is not necessarily a bad thing, like the 1%, 2%. Um, you just have to keep accumulating those stocks, and hopefully you'll see those raises, and then you'll start to see a larger dividend from that point. But I would say don't be afraid of low yields at all. A lot of the American stocks, for the most part, are pretty low yield. Canada's totally different. You can get like an average yield within your portfolio of like 5%. You wouldn't really see that on the U.S. unless you're really chasing those high yield stocks. So
right.
just something to keep in mind.
Yeah, no, that's a great point. Chasing yields can be, I'm not even sure what the word is, but yeah, well, I guess it can be a little bit dangerous because you're looking at these high yields going, oh wow, I'm going to get paid so much in dividends, but then, like you said, the either the share price can tank, so now your capital appreciation is kaput, or again, you can have dividend cuts where looking the other way, like you said, some of these lower yields, there's a lot more room for that dividend growth. And so, it's a balancing act. And again, I agree with you too with those a lot of the Canadian companies, again, with the REITs and the Canadian banks, you can easily put together a portfolio that has say an average of 6, 7, even maybe even 8% yield, right? So which probably sounds scary to a lot of people going, whoa, really? 7,
Hmm.
8%?
Right.
But REITs tend to have a little bit higher yield because of what they are, right? A REIT and the Canadian banks also. I was just looking at a couple of their yields. I was looking at TD and Bank of Nova Scotia, and
Hmm.
it's like okay, I think they were both. I think TD was over 5, and BNS was over 6. So it's just like you know, it,
Yeah.
it it sounds a little scary at first, and then you look back the other way at CNR, and they're at. I'm not even sure if they're at 2%. 1 point, maybe 1.8 or 1.9% yield. So,
Yeah.
and again, it comes down to personal decisions, right? What people are comfortable with, what you and I are comfortable doing. Your time frame too. Like you know, when you started investing at in your 20s or early 30s, you have a much longer time frame than somebody who is like in their late 40s or 50s. So maybe in their late 40s or 50s, like I am, is kind of like, hey, I'm I'm okay with that a little bit higher risk to get that higher yield, but at the
Right.
same time, know that it is a higher risk, right?
Yep. Yeah, I've tried to kind of like balance it out within the portfolio. Like there's certain ones like the REITs, I'm not expecting those to, hit the lottery. I'm just looking for stable income. And
Right.
then there's others that are growth where I'm expecting those to grow. So over time, hopefully there's a balancing act there. And as the portfolio matures and the dividend income matures, we hope to balance it out there. But that's kind of one of the reasons why we have all six banks. It's not because we need to own all six banks, but they're just stable payers, and we know the income will be there, and et cetera. So,
So, a couple of things that I'm thinking here. You said you work in aviation, but you don't own any of the like aviation stocks outright.
mhm.
Is there a reason?
Yeah, I guess as you reach a certain level, there's certain information you get about, airlines, for example, that are somewhat confidential. So I'm not personally at that level yet. But yeah, there are
Enough
rumors.
trickles down for you to say, I don't want to buy Air Canada or WestJet or even Boeing.
Yes, I know a lot about airlines. I I know a lot about different planes. So yeah, people ask me all the time, should I fly with these guys? You know, and but yeah, I try to get away from that. Also, they're not dividend payers, the airlines as well, for the most part.
Right, right.
Um, but exchange income fund kind of has that niche where they're not really part of the airline; they're more part of the transportation business. But the cool thing about working in the industry is that I've got to travel a lot, and from an investing point of view, I get a lot of investing ideas. You know, I spend a lot of time in Latin America, so I see Bank of Nova Scotia everywhere. I was in Chile a couple of weeks ago, and I saw Bank of Nova Scotia, which was cool. But
Nice.
a couple of years ago, I was in China, and before Canada Goose was about to raise their IPO, I was like just stunned to see all these like Canada Goose jackets everywhere, and everybody had them. They weren't knockoffs; they were like legitimate. I was like, okay, this thing's gonna go right. You know,
Right.
so you get certain ideas once you step outside of your your
Your
little
comfort zone.
locale. Yeah, and you really see kind of how the world works, and you get investing ideas that way. So that's kind of helped me just with my investment approach as well. Trying to think big picture. Certainly, the stocks we own in Canada they do have global reach, so that's certainly an important thing for growth. But yeah, something that's been helpful for me for sure.
Yeah, and that's another interesting part out there on your website. I think in the about section where you mentioned like the amount of kilometers you travel in a year is like going around the world 5 times around the world is like so definitely again, link in the description. Go and read that.
Yeah, I actually the most of the blog writing takes place, and I'm not showing off at all, but it's on the airplane. I spend so much time on the airplane, so I
Well,
write a
yeah,
lot of
make the
these.
use of your time while you're just sitting
Yeah,
there, right?
exactly. I can't watch any more movies or things like that. So yeah, that's kind of where the blog started. And yeah, whenever I go on a trip, I'll just write for the blog.
Nice, nice. One, I guess, almost final sector that I want to touch on is heavy industrials. I guess sort of similar. You can, I guess, make a little bit of a comparison to the aviation industry, but
Hmm.
one of my favorite companies. I don't own it, but Caterpillar.
Hmm.
I've worked a lot of construction in the past, and Caterpillar. You just see all of their equipment, whether it's excavators or skid steers or bulldozers or whatever. And obviously, and in the past, I've also kind of lumped John Deere, which is obviously John Deere is more farm equipment, but those types of heavy industrials, the Caterpillars and the John Deeres, or anything else in that sector. What are your thoughts there?
I yeah, for us personally, I think we have some coverage just within the S&P 500, but to along that extent, I would say not only look at the name, but also look at the supply chain. Who supplies, these big industrials? Because that might be a niche opportunity there to
Yeah,
have some ownership. Certainly, they benefit. I can just say, working in aviation, there's only so many certain suppliers. Um, it's very hard to become a supplier to be an approved supplier. So if you can find the suppliers, and if Caterpillar, for example, gets a big purchase order, the supplier is certainly going to benefit, and they're going to raise their prices. So
right.
generally, these tier one suppliers really are able to leverage pricing power in that sense. But yeah, I certainly agree. I think industrials are really tied to economic growth, right? So we're hitting we're going through a bit of a recession right now, but as that picks up again, certainly those would be stocks you want to look at.
Yeah, that's a great point. Is not just look at the company itself, but look at who supplies the company because obviously, when you get into specialized equipment, whether it's say an airplane that Boeing makes or an excavator that Caterpillar makes, there's only so many companies that can supply, the parts and equipment needed to produce those machines. So yeah, that's a very interesting take
Yeah.
for sure. Awesome. Is there anything else you want to talk about?
um, I just want to touch actually on one of my favorite subjects. This is specific for Canada, but the tax-free savings account. I think the tax-free savings account is such an amazing invention by the Canadian government. They rarely do these things, with
The
innovation.
government rarely gets things right, but
So yeah,
once upon a time, way back in 2006, I believe it was, they did one thing right.
yeah. 2009, they introduced it. So today, if you don't have a TFSA, if you haven't made one, created one, and you were over, if you were 18 or older at the time of implementation, you can put, I believe it's up to $88,000 of after
I think it
tax.
might be higher after this year.
Okay, we could double check. But yeah, you can put that in, and I really like leveraging the tax-free savings account with dividend investing
Right.
because all of those dividends are going to become tax-free. The best part about the tax-free savings account is anything you withdraw from the tax-free savings account, you can replace that the following year. So even if you had a
And it's
dividend
tax free.
and it's tax-free, yeah, that's a huge part of our strategy.
Yeah,
As
that's
we
great. Like, say
kind
you
of
have
work to
just easy, quick numbers, quick example. To your point, if you have 20 grand in there, you withdraw 5 grand, it's tax free. The following year, you can replace that 5 grand tax
right.
free.
Exactly. Yeah, yeah. So it's a great strategy, especially as you're looking towards financial independence in Canada. To have this opportunity to grow tax-free money is huge. Certainly, generations after us I think they're going to have much more success with it. Just the ability to compound and compound. And for us, it's a huge part. When I mentioned we started risky investments, we were somewhat successful. Uh, we got early into cannabis before it went crazy. It was all in the TFSA. We took all that money out and we created over six figures of new contribution room. So I've been really leveraging that to plug up the TFSA. So a big part of our strategy is just going to be using that TFSA to create tax-free dividend growth. It does mean that really we have to buy TSX stocks because there's no advantages to there's from a dividend perspective. There's not really a big advantage to holding U.S. stocks in there because you get that 15% withholding tax.
Right.
Um, but yeah, that's a huge part of our strategy is the tax-free savings account. So in the blog, I haven't really touched on it yet, but that's really a topic I want to delve into a lot more and kind of tell our story about how we've been able to leverage that account to our benefit and how we expect to use it, certainly in the future as we reach FI.
Nice. So just to kind of quickly recap what you said there, Canadian stocks, TSX stocks in the TFSA, and then what you hold for U.S. American stocks is in your RRSP, and that is obviously that's all for tax purposes. So that's just
Correct.
I know we've already talked about this through the last. We've been talking for nearly an hour now. Um, for those of you paying attention,
Yeah, there's a quiz at the end of this.
yeah, TFSA is primarily for your TSX Canadian stocks, and then RRSP is where you want to hold your if you have any U.S. stocks, simply because in the TFSA you will get hit with that. I believe you said, and I 15% withholding tax, whereas in the RRSP you will not due to the Canada U.S. tax treaty. Is that the correct terminology?
Correct. Yeah, and when you do withdraw any money from the RSP, you will pay your income tax. So
Right.
Um, and then you also lose any future contribution room. So certainly the tax-free savings account is a superior account. It's unfortunate they called it a savings account. I think just the education there, it's really more of an investing account.
Tax.
But
I've said this so many times.
yeah,
Yeah,
but
a TFSA, it stands for tax-free investment account.
yeah, yeah. But yeah, that's yeah, certainly like talking about that and hope to write about that more in the blog in the months to come.
Awesome, awesome. Well, thank you so much for coming on and spending some time with me on this episode of the Passive Income Podcast. I truly appreciate your time. And I'm going to, any final thought, another 30, 60 seconds, wrap it up.
So every month we have a monthly dividend summary. So within that, it's very unique to me. So I have a family update. I have two young girls, so certainly want to remember all those memories. I spotlight a city I admire, I've traveled to. So I have that traveling side of it. There will be some sort of television I'm watching and my critique on whatever I'm watching. There'll be a podcast or something I listened to last month. I'll talk about that. And then my favorite part about the whole thing is a beef. I try to write kind of a stand-up comedy joke about something that really gets my gears in
Yeah.
society. So that's honestly the hardest thing. I have to come up with something every month, and I'm working on one for next week to come out. And then I do a detailed dividend summary of what we received, what we bought, et cetera, et cetera. So I hope people find enjoyment out of it. The blog is intentionally ad free. I'm not really looking to get anything out of this. Just want to share with the community and hopefully provide some further education if people are interested. So thank you so much, Dave. I really appreciate it. And hopefully I can come on again, and kudos to all the great work you've done. Thank you.
Yeah, awesome. Thank you so much. And link in the description below for Josh's website. Link in the description below for buy investing shirts. Link in the description below for buy me a coffee. You can help support the passive income posse by buying me a coffee. And if you're still watching nearly an hour later, you're still here. These are the rules. Subscribe.